What's going on, everybody? Chris here from projectoption.com. I hope everyone's having a great day. And in today's video, we're going to talk about strangle adjustments. So in particular, the short strangle position that consists of selling a call option and selling a put option. And in this video, we're going to talk about how you can potentially adjust that position by rolling up the short put option. Now, before we get into the specifics, let's briefly cover what rolling means in options trading. Now, sometimes you'll need to make an adjustment to one of your option positions as the stock price changes. In this example, we're going to talk about short strangle positions. Now, in options trading, rolling is the process of closing one of your existing options and opening another option at a different strike price or in a different expiration cycle. Now, when you roll to a different strike price, that's called rolling up or rolling down. And when you roll to a different expiration cycle, that is referred to as rolling out. So rolling out in time. In today's video, we're going to focus on rolling up a short put option, which consists of closing your current short put option by purchasing it back, and then selling another put option at a higher strike price. Now, when you do that in one transaction, it's called rolling up. Now let's go ahead and visualize when you might want to roll up your short put option when you're selling strangles. Now in this visual example, we're looking at hypothetical stock price changes in relation to your short call option strike price and your short put option strike price. Now at the beginning of the period, we can see that the stock price is pretty much in between the short call and short put option, but then it starts to rise towards that short call option. Now, what happens when the stock price rises towards your short call option? Now, as the stock price increases towards your short call strike, the delta of your position becomes more negative, which means you'll start to lose money if the stock price continues to increase. Now, when you initially sell a strangle or an iron condor, typically your position delta will start around 0, which means you don't really have any sensitivity to changes in the stock price. But as the stock price starts to trend in one direction, your position will actually become directional, which, since you're trading a market neutral position, is not what you actually want. Now, while your position is becoming more bearish because your position delta is getting more negative, the short put price and delta are approaching 0, which no longer helps you. So when you're short a strangle, if the stock price increases, you're going to lose a little bit of money on your short call option, but you're going to make some money on your short put option, and the two should offset. However, as your short put option becomes further and further out of the money as the stock price increases, that put option's value is going to fall to 0, which means any further stock price increases aren't really going to generate profits on that put option because it's already worthless. Now, if you can't get any more profits out of that short put option, that means the losses on your short call option as the stock price increases are not going to be offset. Now, what can you do to help the situation? Now, one adjustment you can make to a short strangle position after the stock price has increased towards your short call is to roll up the short put option that you currently have. So since you're currently short that put option, you can roll it up to a higher strike price by purchasing that put option back and then selling another put option at a higher strike price. At this point, you might be wondering, what does rolling up the short put option accomplish? By closing a short put option at a lower strike price and selling a new put option at a higher strike price, you accomplish the following things. The first accomplishment is that you collect more option premium since the new put you sell is more expensive than the put you just bought back. And that's because put options at higher strike prices are more expensive than put options at lower strike prices. So when you sell that higher strike put and purchase back that lower strike put, you collect a credit. Now, when you collect a higher premium on your overall position, that means you have more overall profit potential if the stock price remains in between your short strikes. Additionally, since the upper break-even price of a short strangle is the short call's strike price plus the net premium received, you also extend that break-even point on the upside, which means if the stock continues to rise, you'll actually have a higher break-even point, which gives you more room on the upside for the stock to appreciate. The second thing you accomplish when you roll up the short put option in a short strangle is that your position's delta becomes more neutral, and that means you will lose less money from continued stock price increases. Let's go through a couple examples so that you can fully understand what each of these points actually mean. Let's consider a trader who is currently short the 220 put option, but decides to roll up the 220 put to the 235 put. Now, as we can see in this particular example, the 220 put that this trader is currently short is only trading for 31 cents, which is getting pretty cheap and is not really going to benefit them if the stock price continues to increase. So what this trader can do is they can roll up that 220 put to the 235 put, and they will collect a premium since the new put that they're selling is trading for $1.60, but the put that they bought back, which is their initial 220 put, is trading for 31 cents. Now, by purchasing back that 220 put for 31 cents and selling the 235 put for $1.60, we collect $1.29 of premium for that roll. Now that means that $1.29 of extra premium we just collected will extend our upper break-even price on the short strangle position by $1.29, and that also means that our maximum profit potential increases by $129 per short strangle. Now, what happens to the delta of our strangle position when we make this roll? Now, let's say at the time of the roll, the short strangle position delta is -44, and that means we're expected to lose $44 for each $1 increase in the stock price. So, of course, initially, we wanted our position delta to be around 0 because since we're selling a strangle and we have a market neutral assumption, we don't want our P&L to be sensitive to changes in the stock price. However, as the stock price increases, that becomes more negative because the short call delta starts to get closer to -1, and that short put delta gets closer to 0. Now, here's how the position delta would change after rolling up the put from the 220 strike to the 235 strike. Now, since our old put at the 220 strike has a delta of -6, a $1 increase in that share price is going to lead to a 6-cent decrease in the options price. Now, since we're short the 220 put, a 6-cent decrease would yield $6 in profits, and that's where the position delta of +6 comes from. Now, that 235 put that we're rolling to has a delta of -30, which means if the stock price increases by $1, that put is expected to lose 30 cents in value. Now, if we're short a put option that loses 30 cents, that's going to yield $30 in profits for us, which explains the position delta of +30 for that 235 put. Now that means the overall change in our position delta is +24. Now that means our new short strangles position delta goes to -20. So before we made the roll, the position delta was -44, which means if the stock price increases by $1, we're expected to lose $44. Now, after we rolled the 220 put up to the 235 put, our new short strangle position delta is now -20, which means if the stock price increases by $1, we're only expected to lose $20 as opposed to $44. So by rolling up that short put option to a higher strike price, we neutralize our short strangle's position delta. Now, in this particular example, we did not completely eliminate their directional risk, but we did cut it in half. Now that we've discussed how you can adjust a short strangle after the stock price increases substantially, we need to talk about the downsides of rolling up that short put. Now, while rolling up a short put increases your premium received and neutralizes your position delta, there are some downsides. Now, the first downside is that you decrease the probability of making money on the trade because your put strike price is now closer to the stock price. So since you roll up that short put to a strike price that is closer to your short call strike price, you have a narrower range of profitability. However, you do extend the break-even on the upside because you collect more premium. The second downside is that your position delta gets neutralized, which means a reversal in the stock price will yield less profits than if you didn't roll at all. So in the previous example, the position delta before rolling up the short put was -44. So that means if the stock price actually fell by $1, we were expected to make $44. However, after we rolled up the short put and our position delta adjusted to -20, if the stock price fell by $1, we would only be expected to profit by $20. And lastly, there is a possibility that the stock price reverses completely, in which case your position delta will start to grow positive, which means you'll start to lose money as the stock price continues to decrease. Alright, well that wraps up the short strangle adjustment of rolling up the short put option, but let's quickly run through some concept checks to recap what you've learned in this video. First of all, when selling strangles, if the share price appreciates towards your short call, you can adjust the position by rolling up the short put option. By rolling up the old put to a higher strike price, you increase your premium collected, which extends your break even on the upside, and that gives you more room for the stock price to increase. And you also neutralize your position delta, which means if the stock price continues to increase, you'll lose less money than if you had not rolled up the short put. Now, the downside of rolling up the short put is that you decrease the probability of making money since you have a tighter range of profitability, and you'll make less money or potentially lose money from reversals in the stock price. So always keep in mind that when you make an adjustment to a trade, there is always a trade-off. Thank you so much for watching this video, everybody. I hope you enjoyed it. If you did, please do us a favor by liking the video down below. Subscribe to our YouTube channel so that you can continue learning with us, and also feel free to watch some more videos by clicking on that video on the right-hand side.